I've watched more smart, hardworking people go broke than I care to remember, not because they were lazy, not because they were unlucky, because they understood one idea about compounding and quietly violated 39 others every single day without ever knowing it. See, everyone's heard the phrase Einstein's eighth wonder. Compound interest. They nod, they open a brokerage account, and then they proceed to break 15 of compounding's laws before the week is out. Here's what nobody tells you. Compounding isn't just a formula, it's a system, a fortress built on 40 separate laws, and when you violate even one of them, the whole structure develops a crack. And cracks in the right storm become collapses. Today, I'm giving you all 40, the laws I've lived by for 75 years, the ones the quietly wealthy follow in total silence, while the rest of the world wonders why they can never seem to get ahead. Some of these will feel familiar. A few are going to hit you somewhere uncomfortable. Good. That's exactly what they're supposed to do. You know, back in 1942, I was 11 years old. World War II was raging. The entire country was consumed by fear. Nobody was talking about wealth building, but I just read a book, 1,000 Ways to Make $1,000, and something clicked, a direction. A law I couldn't yet name. My mentor, Benjamin Graham, put words to it later. He told me that an investor's chief problem and their worst enemy is likely to be themselves, not the market, not the economy themselves. He was describing the 40 laws your own behavior silently breaks every single day. Let's build the fortress law by law, brick by brick. Law number 1, time is your greatest ally. People ask me constantly, what's the single most important ingredient in wealth? They expect me to say discipline, intelligence, work ethic. I say time. Always time. I've said this for decades, and I'll say it once more. If I had waited until I was 30 to start investing, I would have retired with a fraction of what I ultimately built. Every year you delay doesn't cost you 1 year of compounding. It costs you exponentially more. The market rewards the early and punishes the late, without mercy, without exceptions. Law 2. Small, persistent steps destroy big and consistent leaps. Here's a question. Would you rather have $1 million today or a single penny doubled every day for 30 days? Most people grab the million. They always grab the million. The penny becomes $5.3 million. That's not magic. That's arithmetic. And arithmetic does not care about your impatience, does not care. The speculator swings for the grand slam once a year and spends the rest of the time in the dugout wondering why his portfolio hasn't moved. The investor shows up every single month, rain or shine, bull or bear, with whatever they've got, and lets time do the lifting. Law 3, patience is a financial superpower. Charlie Munger said the big money isn't in the buying and selling, it's in the waiting. I've held Coca-Cola since 1988, 37 years. I have not called anyone in a panic when the stock dropped. I have not celebrated when it surged. I have done almost nothing. And that deliberate, disciplined nothingness, that is one of the most powerful wealth-building moves I ever made. Law 4, time in the market, not timing the market. I have never, not once in 75 years, successfully timed the market on a consistent basis, not once. And I've been doing this since Truman was president, so what chance does a 34-year-old with a smartphone trading app have? The best day to invest was 20 years ago. The second best day is today. Get in, stay in, stop trying to be clever. Law 5, keep faith in long-term results. In 2008, the world was ending, or at least that's what every TV screen was screaming, markets down 50%. Major banks collapsing, complete financial panic in the streets. I wrote an op-ed in the New York Times. People genuinely thought I'd lost my mind, but I had something the crowd didn't. Faith built on history, on the undeniable fact that this country has recovered from every single crisis it has ever faced. Everyone, the investor who holds that faith when everyone else abandons it, that investor retires wealthy. Law 6, start before you feel ready. You know, the most dangerous phrase in personal finance. I'll start investing when I have more time, more money, more certainty, more clarity. That certainty never arrives. And every month you wait is a month of compounding you cannot recapture for the rest of your life. You don't need $10,000 to start. You need $10 and the decision to begin, because starting the clock is the entire game. Law 7, respect the snowball effect. My biography is called The Snowball. That wasn't accidental. A snowball at the top of a very long hill, you could stop it with one finger. It weighs almost nothing. It means almost nothing, but leave it alone. Let it roll. Let it accumulate. And by the time it reaches the bottom, nothing stops it. Nothing. Your portfolio works the same way. The hardest part is starting the roll. The single most important thing is resisting the urge to pick it up along the way. Law 8, protect your seed principle like your life depends on it. Rule number 1, never lose money. Rule number 2, never forget rule number 1. I didn't invent those rules. I just lived by them for 7 decades. Here's why they matter more than anything else I'll tell you today. You cannot compound what you destroy. Every time you dip into your investment capital for a vacation, you'll forget. A car that loses value the moment you drive it off the lot. A luxury the salesman convinced you that you needed. You don't just spend that dollar. You erase every dollar that dollar was supposed to become over the next 30 years. Guard the seed always. Law 9, reinvest your dividends every single time. Most people receive a dividend payment and they feel momentarily wealthy. They celebrate, then spend it. That's not how fortresses are built. A reinvested dividend buys more shares earn more dividends buy more shares. It is a machine that feeds itself, but only if you never touch the fuel. The numbers are almost hard to believe. $10,000 in the S&P 500 in 1980, dividends spent, roughly $700,000 today. Same $10,000 dividends reinvested, over $1.5 million. Same investment, same time period, double the result just from leaving it alone. Law 10, hunt the silent fee thieves. Now listen to me closely here, because most investors walk right past this law for their entire lives and never once notice the money silently draining away. A 1% annual management fee sounds harmless, doesn't it? Barely anything. Over 30 years on a $100,000 portfolio, that 1% quietly steals over $90,000 from you. $90,000 gone in fees you barely noticed were being charged, low-cost index funds. That's your defense against the fee thieves. John Bogle built Vanguard on this single principle, and he was one of the finest friends the retail investor ever had. Law 11, become tax smart, not tax paralyzed Ed. The government is your silent business partner in every investment you make. You didn't invite them. You cannot fire them, but you absolutely can manage how much they take. Max your 401k, fill your IRA, hold investments long enough to qualify for long-term capital gains treatment. Use tax loss harvesting when markets dip. These aren't loopholes. These are the rules of the game, and the wealthy play by them every single day. Why would you leave that advantage on the table? Law 12, automate your discipline. Remove yourself from the equation. Here's the uncomfortable truth about investing. Your biggest enemy is you, your emotions, your second guessing, your impulse to wait and see what the market does next week. So remove yourself entirely. Set automatic contributions every paycheck without looking, without feeling, without giving yourself the option to talk yourself out of it. The investor who automates wins every time. The investor who relies on memory and motivation loses every time. Law 13, diversify intelligently. Don't diversify. Charlie used that word. Diversify, and it's still the sharpest thing anyone said about bad diversification. Owning 200 different stocks isn't a strategy, it's a filing system pretending to be a fortress. True diversification means different asset classes, different sectors, different geographies placed across your portfolio like load-bearing walls. Remove one wall and the structure still stands. That's the goal. That's always been the goal. Law 14, understand what every dollar truly costs you. This one changes how you see money forever. Every dollar you spend on something forgettable isn't just that dollar lost. It's every single dollar that dollar could have become. That $5 daily coffee habit over 30 years, invested instead at 10% annually, it compounds to over $100,000. I'm not telling you to stop drinking coffee. I'm telling you to understand the true price of everything you buy, because you're always trading something. Law 15, destroy high interest debt first. Always first. Consumer debt is compounding, working backwards against you around the clock while you sleep peacefully unaware of it. Carrying a credit card balance at 22% interest while your investments grow at 10%. You are mathematically moving in reverse every single day. Destroy the high interest debt before you invest anything, before anything else, because you cannot build a fortress on a foundation that is actively crumbling beneath your feet. Law 16, always keep dry powder. Always in 2008, while Wall Street was drowning in panic and selling every asset they owned, Berkshire Hathaway had $44 billion sitting in cash reserves, dry powder, ammunition, options. We deployed it at fire sale prices that the history of markets will likely never offer again. The speculator stays fully invested at all times. So when the great sale arrives, they have nothing left to spend. The investor always keeps a reserve, because the best opportunities in 75 years of wealth building have arrived precisely when the world looked its absolute worst. Part 3, mindset and knowledge. Laws 17 through 24. Law 17, build emotional guardrails. Your feelings are not your financial advisor. I've said this for 50 years. The stock market is a device for transferring money from the impatient to the patient. Every single crash is a sale event. But most investors treat it like a house fire. They run, they sell low, they buy high. They do the exact mathematical opposite of what creates wealth. Build those emotional guardrails high, build them thick. When the sirens start, when the headlines get loud, the investor stands perfectly still. Law 18, knowledge is the only asset that compounds without risk. I read 500 pages a day, have done for most of my adult life. People think that's an exaggeration. It is not even slightly. Every book compounds the one before it. Every idea builds on a previous idea. Knowledge earns interest, wisdom earns interest. And the one truly remarkable thing about intellectual compounding, nobody can tax it, nobody can steal it, inflation cannot touch it. It is the single indestructible asset class available to every human being alive. Law 19, humility protects you before ego destroys you. I have watched genuinely brilliant men lose entire fortunes in the market, not from lack of intelligence, from too much of it. Ego whispers, I can beat the market. I see what others miss. This time is different. The market is the most efficient, humbling machine ever built. Feed it ego and it will feast on you. The investor who knows the exact boundary of what they do not know is infinitely safer than the genius who believes they understand everything. Law 20, know your why, deploy, and honestly, here's a question most investors never actually ask themselves. Why am I building this? Not the surface answer, the real one: freedom, security for your children, never working a job you hate again, never answering to someone you don't respect. The clarity of your why is the fuel that keeps discipline alive through the dark moments, through 2008, through March 2020, through every gut punch the market delivers. Without a compelling reason, discipline evaporates the instant it costs something. Law 21, guard your circle as carefully as your portfolio. You're the average of the 5 people you spend the most time with. I had Charlie Munger for 60 years. Every conversation made me sharper. He challenged my thinking. He pointed out my blind spots. He made me a better investor and a better human being because of it. If your inner circle mocks saving, celebrates spending, and chases whatever hot tip is trending that week, you're swimming directly upstream against your own financial future. Protect your circle fiercely, or your circle quietly becomes your ceiling. Law 22, celebrate small wins, they compound too. Now, this one might sound soft, but hear me out. The investor who celebrates the first $1,000 saved, the first dividend received, the first full year of consistent contributions, That investor reinforces the exact behaviors that build wealth over a lifetime. The investor who waits until the $1 million milestone to feel any satisfaction, they quit long before they ever get there. Small wins are fuel. You need them more than you think. Law 23, learn from failure without being buried by it. I bought Berkshire Hathaway, a dying textile mill. It was a genuine mistake that cost me billions in opportunity cost over the decades. I've said that publicly many times, but do you know what it taught me? To buy wonderful companies at fair prices rather than fair companies at cheap prices. That single lesson, born directly from failure, shaped the entire second half of my investing life. Your losses contain your most valuable education. Don't waste them by only feeling the pain. Law 24. Build an inner scorecard. Stop performing wealth. Here's the real test of financial character. Are you building wealth because you genuinely believe in the principles? Or are you performing wealth because you want the approval of people whose opinions shouldn't matter to you? The outer scorecard drives lifestyle inflation. It drives debt taken on for things that lose value the moment you buy them. It drives the exhausting, expensive theater of looking wealthy without the reality of actually being wealthy. Build your fortress for yourself, for your freedom, for your sleep, not for the neighbors. Part 4, strategic growth, laws 25 through 32. Law 25, your skills and habits compound exactly like your money. The best investment I ever made wasn't Coca-Cola, it was an apple. It was a Dale Carnegie public speaking course I took as a young, terrified man. Cost me $100. That $100 is worth more to me than almost any stock position I ever held. Because skills compound, habits compound. A 1% improvement in your discipline, your thinking, your communication, the interest rate on that investment dwarfs any index fund. Build yourself first. The financial compounding follows naturally. Law 26. Normalize market volatility. Don't earns or sales events. Let me say something that should permanently reshape how you experience every market downturn from this day forward. Down markets are sales events. Sales events. When your favorite grocery store puts steak on sale, 40% off, you don't run out of the store screaming. You load the cart. But when the stock market goes on that same 40% sale, most investors abandon the cart and sprint for the exit. The investor who has normalized volatility, who expects it, who welcomes it, who uses it, builds wealth during the very moments that are destroying everyone else. Law 27. Inaction has a price. Calculated risk is mandatory. Look, I know this channel stands for capital protection. It does, but here's a truth most cautious investors miss entirely. Keeping all your money in cash is not safe. Inflation running at 3% annually cuts your purchasing power in half every 24 years, in half silently, without a single headline, without a single warning. The real risk isn't losing money in a market downturn. The real risk is watching inflation quietly dismantle your fortress brick by brick while you believe you're being cautious. Law 28. Adapt without abandoning your principles. Over 75 years, I've had to adapt many times. I started as a cigar butt investor, finding dying companies with one last puff of value left. Charlie changed me. He taught me to buy wonderful businesses and hold them for decades. The principles never changed. The application sometimes had to. The investor who clings rigidly to an outdated strategy because it once worked without honestly asking whether the world has since shifted is building a fortress on sand. Law 29 aligns your strategy with your life stage. A 25-year-old and a 65-year-old should not hold identical portfolios. This sounds completely obvious. And yet you would be stunned by how many people never adjust. At 25, time is your most powerful asset. You can afford significant volatility and should embrace it. At 65, your greatest asset is what you've carefully preserved. You cannot afford to start to climb again from the bottom. Review your strategy as your life evolves. Every season demands different fortress walls. Law 30, build multiple streams of income. I have never, at any point in my adult life, relied on a single source of income. Dividends, business Fixed income instruments, real estate holdings, multiple income streams don't just protect you when one dries up. They compound differently. They grow in entirely different economic seasons. They insulate you from the unpredictability of any single market or industry. The investor with one income stream is a one-legged man in a financial storm. Build the second leg, then the third, then the fourth. Law 31. Concentrate when the odds are truly overwhelming. Now, this one might surprise you given what I've said about diversification. But Charlie was absolute on this, and he was right. The wise investor waits years for the genuinely fat pitch. And when it finally arrives, when the odds are overwhelmingly stacked in your favor, you do not bunt. You swing hard, heavy. Diversification protects against ignorance. At the rare moment of overwhelming demonstrable opportunity, concentration is what builds generational fortunes. Law 32. Compound your reputation as much as your capital. It takes 20 years to build a reputation and 5 minutes to ruin it. And a great reputation for integrity, for reliability, for rational judgment opens doors that money alone can never buy. The investor, known for honest dealing, attracts the best partners, the best opportunities, the best terms. Your character compounds exactly like your capital. And just like your capital, it can be lost in a single, reckless, unguarded moment. Protect both equally. Part 5, Wealth Preservation and Purposes, Laws 33 through 40. Law 33, freedom is the true prize, not possessions. I still live in the same house I bought in 1958 for $31,500. Some people think that's peculiar. I think it's the sanest financial decision I ever made. Every dollar not wasted on something bigger and shinier was a dollar that compounded into something that matters infinitely more: freedom. The freedom to wake every single morning and do exactly what you love with exactly who you love, entirely on your own terms. That's the prize, not the car, not the house, not the performance of wealth. Real wealth is quiet. Real wealth sleeps well. Real wealth never needs to prove itself to anyone. Real wealth is quiet. It sleeps well. It needs no proof. Law 34, guard against lifestyle inflation, the invisible wealth destroyer. Here is the most insidious wealth destroyer I've witnessed across 75 years. Not market crashes, not bad individual investments, lifestyle inflation, every raise spent on a better car, every bonus spent on a bigger house. The income climbs and the wealth never follows. Never. The speculator celebrates every raise with a new expense. The investor celebrates every raise with a new investment. Same income, completely different destination 30 years from now. Law 35, protect what you've built. Insurance is wisdom, not pessimism. People skip this law. They say insurance is for people who expect the worst. I say it's for people who understand that all it takes is one catastrophic medical event, one uninsured disaster, one major liability lawsuit to erase decades of careful, disciplined compounding. In a single moment you build a fortress and then you insure the fortress. That is not fear. That is the rational protection of everything you've worked your entire life to create. Law 36, build for legacy. Your wealth should outlive you. I've committed to giving away the vast majority of my wealth to the Gates Foundation, to institutions I genuinely believe in, because I think the compounding effect of a dollar put to real, meaningful use outweighs a dollar sitting idle in a vault somewhere. But before I could give it away, I had to build it deliberately, patiently, over many decades. Ask yourself what you're truly building for. Your children, your grandchildren, your community. Wealth that outlives its creator compounds in ways you'll never personally witness, but you'll feel the rightness of building it every single day you're alive. Law 37, take plackets wisely, harvest without killing the crop. There is absolutely a time to harvest, to rebalance, to take some gains off the table, but never sell the entire field. Never kill the goose. The wise farmer harvests what he needs and replants the rest with care. The foolish farmer sells the entire farm the moment the first season looks profitable. Know the difference between harvesting and liquidating. One sustains wealth across generations, the other ends the compounding story permanently. Law 38, review and adjust. Your fortress demands an annual inspection. Even the greatest fortresses in history required regular maintenance. Walls crack, foundations shift, conditions around them change completely. Your financial fortress is no different. Once a year at minimum, sit down with your complete financial picture, every position, every liability, every automatic expense. Ask yourself, honestly, is this still working? Has the world changed? Has my life stage changed? Does this still serve the reason I started building in the first place? The investor who never reviews slowly accumulates invisible cracks. The one who inspects and repairs builds something that genuinely lasts. Law 39, quiet money outlasts loud money. Every single time old money whispers, new money shouts. Always been that way, always will be. I've watched people build wealth in complete, deliberate silence. No announcements, no expensive displays, no social performance. And I've watched people announce their wealth loudly to anyone who would listen and lose it within a decade. A decade. Quiet money doesn't need validation, doesn't need applause, doesn't need a single person to know it exists. Quiet money compounds, loud money leaks. Law 40, sleep well. That is the only test that ultimately matters. Here's the last law, and in many ways, the most important one, the one that governs every other law on this entire list. For 75 years, I've run every investment decision, every business partnership, every financial commitment through one single filter. Will I sleep well tonight? If the answer is yes, I proceed. If the answer is no, I walk away, no matter how tempting it looks on paper, no matter what the crowd is piling into, no matter how loudly the salesman promises the world. Benjamin Graham taught me to always invest with a margin of safety, to never bet more than I could afford to lose, and never own anything I didn't fully understand. And Charlie Munger taught me to invert, to ask not just what could go right, but precisely what happens when it goes wrong. Both lessons in the end point to the exact same truth. The investor who sleeps soundly has built something real, something durable, something the next panic, the next crash, the next terrifying headline cannot touch. The investor who sleeps soundly has built something no market crash can touch. The speculator lies awake at 3 a.m. checking prices, second-guessing every decision, chasing the ghost of what they should have done. The investor sleeps deeply, quietly, because they know what they own, they know why they own it, and they know with absolute certainty that time is on their side. That's the fortress. All 40 laws of it, built law by law, brick by brick, available to anyone willing to start. Starting today, compounding doesn't care about your background. It doesn't care about your income level. It doesn't care about where you started or how late you think you are. It cares about three things only: whether you start, whether you stay consistent, and whether you ferociously protect what you've built. That's the whole game, the entire game. Now, a word of honesty. Before we close today, everything shared here is for educational and entertainment purposes only. I am not your financial advisor. Please always consult a qualified financial professional before making any investment decisions, but these 40 laws, they're 75 years of lived experience, and they belong to you now. If this video gave you even one law, one single idea that helps strengthen your fortress, do something for me. Hit that like button. And if you want to keep building right here at Elite Money Mindset, subscribe. There's a great deal more left to build together. The journey to real wealth is not a sprint. It's not a lottery ticket. It's not the next hot tip showing up in your inbox. It's 40 quiet laws applied consistently, protected ferociously for a very, very long time. Now go build your fortress and sleep well tonight.